The S&P 500 just touched an all-time high, 6,945.77. Every headline is screaming that we had a great success in 2025. Victory! Booming economy firing on all cylinders. But here's what those headlines won't tell you. The real story of 2025 isn't about that number. It's about the weird contradictions hiding just beneath the surface and what that means for next year and beyond. Anxious consumers while markets soar? A 70% stealth rally? Nobody noticed? And specific companies in our portfolio that move sharply in both directions? That's what we're breaking down today. And stick around because one of our biggest losers of the year just had a week that might change everything going forward. I'm David Berkowitz with ValueAligned Partners. Every week I share what's actually happening in our portfolio and some of the stories that affect that portfolio, the wins, the losses, the reasoning behind both. I'm not here to sell you a narrative. I'm here to show you how we think about owning businesses for the long term. Because there's a difference between watching stock prices bounce around and understanding what's actually happening inside the companies and around the companies that you own. So let's start with the big picture. Then we'll get specific. The Santa Claus rally delivered. The S&P 500 gained 1.4% in a shortened holiday week. NASDAQ jumped 1.5%, and the small capitalization stocks, the small ones, lagged at 0.8%. Now that pattern certainly matters. When the S&P 500 index ETF outpaces the equal weighted S&P 500 ETF, the RSP, it tells us that the big mega cap stocks are doing all the heavy lifting. Tech leadership continues. But here's what caught my attention. All 11 sectors finished in the green. That's a good day, and that's unusual, and it signals healthy risk appetite across the market, not just narrow speculation in a few names. Materials led the pack, up 2.2%. Financials followed at 1.8%, and consumer staples barely moved, up just 0.1%, but it was still positive. The market is telling us something. Investors want growth, they want risk. They're not hiding in defensive names, but beneath that confidence, there's still a puzzle. Here's the first contradiction nobody seems to be talking about. The hard economic data looks fantastic. The third revision for Q3 GDP came in at 4.3% growth. That's the fastest pace in 2 years. Jobless claims fell to 214,000, lowest since January. Employers aren't laying people off, and people are working and spending, certainly. But then you look at how consumers actually feel. Consumer confidence dropped to 89.1. That's the lowest since April. And here's the concerning part. The expectations index in the consumer confidence index stayed below 80 for 11 straight months. Historically, that threshold signals recession risk over the next year. So which do we trust? What the economy is doing or what people are saying? Even the Fed doesn't know what to do. Chairman Powell said they're in a wait-and-see mode. That tension between story and reality isn't just in the macro data, it's playing out in individual stocks too. For years, the big tech giants ran their own kingdoms, quasi-monopolies, limited, direct competition. AI shattered that peace. It forced them all onto the same battlefield. And here's the question everyone should be asking. Who actually wins this incredibly expensive war? Is it the companies spending tens of billions to build AI, like OpenAI, ChatGPT, Google, Gemini, Microsoft, Amazon? Or is it the companies that can simply use AI to boost their own productivity, which is everything else? Think about it. Healthcare using AI to accelerate drug discovery, financials automating complex analysis, and industrials optimizing supply chains. The real winners might not be the ones selling the shovels, they might be the ones using them, or they might be both. Keep that in mind because it shows up in our portfolio this week. Our portfolio gained roughly 1.3% for the week, right in line with the broader market. But beneath that aggregate number, individual holdings moved sharply, some way up, some down. Let me show you both sides. Let's start with the winners. Novo Nordisk jumped nearly 9% for the week. And here's why that matters. Remember from the beginning, the big loser that might change everything? Well, this is it. Novo is down 39% for the year after this week's 9% gain. It's our worst performer. We're not down as much as 39% because remember, we bought it on the way down. So our loss is, so far, our paper loss is not anything like 39%, but still it's our biggest loser. But on December 22nd, the FDA approved oral Wegovy, the first pill form of GLP-1 drug approved for weight management. Clinical trials showed almost 17% weight loss over 64 weeks. That's a little over a year. And that beat Eli Lilly's competing drug. So here's why this matters for the business. Injectable Wegovy has faced persistent manufacturing shortages. An oral version offers a different production pathway, and it expands the market to patients who don't like taking injections or don't like taking injections for a very long time. Novo plans to launch in early January at $149 per month. 1 week doesn't erase the 39% decline, of course, but this approval represents a genuine inflection point, and Novo Nordisk stock price needs to catch up to intrinsic value. NVIDIA, the chip maker, gained 5.3%. The catalyst? A $20 billion deal with Groq, G-R-O-Q. Groq builds chips specifically for AI inference. That is, after the big LLM, they call them, LLM models get trained on all the data in the world, running trained models are what inference is. They're making active decisions. They're activating on the LLM models. And that's been a little bit of a vulnerability for NVIDIA because by absorbing this technology, they're closing a gap competitors might have exploited later on. Taiwan Semiconductor rose 4.8%. November revenue confirmed that story. It's up 24.5% year over year, and the company manufactures 90% of the world's most advanced chips. That means they make them. The other companies like NVIDIA, they design them, but it is Taiwan Semiconductor that has the know-how to manufacture the most advanced chips. AI infrastructure spending isn't slowing down yet. Now, if you're watching this and wondering how these companies fit into your own situation, we offer a free consultation for serious long-term investors. It's not a sales pitch. It's a real conversation about your goals and how our portfolio and our process might fit with your goals. The link's in the description and also in the pinned comment. Back to the portfolio. Now, the bottom performers, now the other side. Tesla slipped only 1.25%, but this one deserves some attention. The stock is up 18% for the year, but here's the disconnect. European sales of Tesla's electric cars plunged 34% in November. Year to date, European volumes down nearly 39%. U.S. November sales fell 23%. 3-year low. China faces its first annual sales decline of Teslas this year. The stock went up because investors bought the AI and robotics story. And it's quite a story. But the actual business of selling cars, kind of struggling right about now. And remember, we had some incentives by the U.S. government go away this year. There were some problems because of people firebombing Teslas and because people were protesting Elon Musk's government intervention. But Morgan Stanley downgraded the stock to equal weight with a $425 target during the week. And it's the same tension we see in the broader market. Future promise versus present reality. We maintain a modest position in Tesla, but the gap between stock performance and operating results, we warrant close monitoring. But that's why we only have a 1% position. We will buy a lot more if and when Tesla has its next big correction. NXP Semiconductors fell 1.5%, another semi stock, but it's automotive chips. And automotive chips face a little bit of uncertainty because of that electrical vehicle demand question. Inventory adjustments also in cars, but the content per vehicle story remains intact. Cars are becoming computers on wheels. We view this as cyclical weakness, not structural damage, and we believe that NXP Semiconductor is a long-term compounder. Now, Diamondback Energy dropped 1.2%. The energy sector stayed quiet. Oil held near $60, down 11% for the year, but still generating cash flow. The position gives us optionality if oil prices rise. Now, one more thing before we wrap up. While everyone focused on AI and tech stocks, one asset quietly had its best year in 4 decades. Gold, up 70% so far in 2025. 54 record closes. Spot gold touched $4,525 per ounce on Friday. Central bank buying, global uncertainty, the oldest asset in the world is outperforming almost everything. It's a reminder that the most important trends often unfold outside of what everybody else is focusing on. So where does it leave us heading into 2026? Markets are near all-time highs. Valuations are stretched by historical standards. Consumer sentiment flashes warning signs even as hard data stays strong. Surprisingly strong, actually. AI infrastructure spending shows no signs of slowing yet, and the companies in our portfolio keep operating, generating revenue, investing in growth, returning cash to shareholders. The weekly price moves we discussed today will fade into statistical noise within months. The underlying business performance compounds over years, and we expect our portfolio to compound between 15 and 25% in intrinsic value. And we're happy to wait for the stock market to catch up to the growing intrinsic value. That's the discipline we follow. Stay invested in quality companies, ignore the noise, let time do the heavy lifting. If you want help building a portfolio that reflects your actual goals, risk tolerance, schedule a free consultation. Link in the description and pinned comment. We're not for everyone, just for investors who think in years, not in days.